Hello, everyone. Jacob Shaparo here with Zenith alongside my colleague Pablo Marul. This is your July market update here with us. And it's a great time to assess what took place here the first half of the year. We enter the second half. The markets just kind of caught fire, truthfully, here domestically at least. So, a couple of things that we'll talk about for this market update. Give you an idea to recap how equities have performed across the board, give you an idea also how fixed income has performed, give you an understanding also some expectations, second half of what we see, what to keep an eye on, and as well as talking about inflation and how much of a concern that is in a lot of people's minds. Thank you, a special thanks to our clients who are watching. If you're viewing, thank you as well. Pablo, how you doing? Summertime has begun. How you doing, man?
Very good. Very excited to share with our audience to see what has happened in the first half of the year. It's always good to make a summary. And if you want, I can start it to give you some data and explain why this is important for our clients.
Definitely, yeah. Please do.
Well, basically, everything started with this change in the value versus growth. And in the first half of the year, the sector that they explain the value group, like financials, like industrial, they have outperformed the Standard & Poor 500, which for the year was 14%. Financial, for instance, was 24%. So why this is important for you? Because again, your assets are tied to your IRA, your saving assets are tied to these sectors, to like value and growth. For instance, growth, which is information technology or communication services, are two sectors that explain the value style. I'm sorry, the growth style. They have not performed very well relative to the Standard & Poor 500. But it's important to understand that since June 11, growth or tech, they have been outperforming value. Okay, this is important to consider.
And just to make sure that we can relate here, when we talk about growth and value, these are different types of companies. So there's three major types of companies when you look at stocks. Some are deemed value, more dividend paying companies. Some are deemed growth, that are more aggressive in their nature in terms of trying to propel their company forward. And within that, there are different sectors, different types of companies. Pablo mentioned tech, that is a notorious growth sector as a whole. And I think Pablo was financials that you mentioned, typically banks and insurance companies, financial institutions that are more value oriented. So for us, we like to make sure we understand how the market's progressing. And I think the number was 14% that the S&P 500 has performed, which is incredible.
It's
for
amazing.
the first half of the year.
It's very good. Yeah.
So yeah, sorry, Pablo, to interject. I just wanted to make sure that the value and growth dynamic, we are condensing this down and simplifying it, and we know because for us to understand not just how the market's performing, but where it's coming from and how is obviously how we're trying to make good decisions for our clients, and understanding the differences and potentially be able to forecast, hopefully, and understand what's going to take place. That's a big important factor, of course.
Totally, and it's important to explain sometimes. But people hear about value growth. So far, value has been beating growth, but in the last month, growth is coming back. And the other part that, for instance, small cap technology, they have generated most of the return in the first months of the first half, and then it stay kind of in the similar. After March, they stay they have not grown that much, but they for instance, year to date, small cap has been very good. is around 18%, the Russell 2000. And then you have emerging market, 6%, and Europe and Japan around 7%. So they have been lagging again relative to the US. But again, I think we talk about equity, which is important, but also it's important to talk about fixed income. And I would like to share to our clients why is important fixed income. And you have fixed income in your portfolios. Everyone has fixed income because it's good to control the risk of a portfolio, to create a well-diversified portfolio. For instance, investment grade is one of the asset class in fixed income that is used in our portfolios, and many advisors use it. So far, it has declined 2% year to date. That's one of the explanation is the increase in interest rate in the first, let's say, 3 months of the year. 3 months. This is important to mark. No, the same happened with TLT. This is in long government bonds. The long duration has been very bad year to date. Almost 10% negative. But again, 10-year increase in the first 3 months. But after the first 3 months, it came down. So we will discuss this later because it has changed a lot of views regarding the fixed income.
And as you know, our viewers are looking at this chart here with us and recapping fixed income, aka bonds. You know, these are the two biggest components of your portfolio, typically stocks / equities or fixed income / bonds. It's been really unique year. As you see here, the biggest lagger, as Pablo pointed out, has been the US Treasury 20-year bond, almost negative 10% here. It's a different dynamic because the movement in interest rates really one of those factors that drive bond prices either up or down. So that inverse correlation, bond prices go down, interest rates go up, and vice versa. Naturally, the biggest duration bonds are going to suffer the most, as we're seeing this year. So when we talk about protection and we talk about incorporating bonds in your portfolio, there's still risk within that because you have not only U.S. Treasuries deemed the most conservative, but you also have corporate bonds, and which we'll kind of get into how they perform in terms of treasuries. But you know, to make sure there's a good takeaway here, and the things that we're looking at is understanding also the duration, or in other words, the terms. Are they short term, less than 5 years? Are they intermediate, less than 10 years? Or are they long term, 10 plus years? Right now, so far, again, to reference the chart, long-term treasuries have really taken a beating this year. So it'd be interesting to see what that trend line looks like heading into the second year, and some of the changes that we're doing and proactively seeing, you know, how we can approach this and take advantage of, you know, what took place the first half, and to expect hopefully a couple of things to capture some good returns and protection into the second half.
And it's important because diversification is important also in fixed income. And for instance, high yield, they have they have done very well, 2.5% in the year, basically because the equity markets have done very well, and usually high yield performs similar to the equity market. U.S. Treasury or TIPS, which is inflation protection bonds, they have done well, 1.2. And also the target maturity. So this is type of funds that they have a specific maturity, and that's kind of give you short duration. So if interest rate increase, they're not going to be affected. They will protect the value, and they will give you some yield, because in this case they are investment grade. So this is important. Always is important to have diversification in equity and also in fixed income.
Yeah. It's an excellent point. I think as we kind of reach the halfway point here of our session, this update, we'll definitely get to some communication to you all of what we are seeing, what we're keeping a close eye on as we enter the second half here. But, you know, to recap, both on the equity and fixed income side. Domestic stocks for the first half have really exploded. They've been led by financials. They've been led by value. We're starting to see this shift in dynamic as we started the conversation of technology, which has been lagging a lot this year in comparison to last year. It just propelled. That's starting to pick up. We're starting to see this change again from value oriented stocks now lagging and growth companies taking over. It's going to be a really interesting second half, and already an interesting month already being midway in July to see when we're going to see a potential correction, which is defined as a 10% sell off or more from the highs. We haven't seen that since COVID, and typically this happens every year or so. I think the metric is not 9 months on average, Pablo. That's the average. Of course, there's more time in between, but we'll kind of talk about what to expect. The last thing I'll say on that front before we move on to talking about one of the biggest things we're looking at is inflation. To finish the thought on the fixed income side, to Pablo's own words, it's important to be able to diversify within those different types of bonds because there's still some risk to be carried, whether it's the duration of them or the different types, whether it's again treasuries or corporate bonds. These are things consistently that we're assessing, we're researching, we're analyzing to make sure that we're not exposed to some investments that are going to put us in a tough position. And this year with the fixed income side, it's been definitely not a traditional year when it comes to that. Wouldn't you say, Pablo?
Totally, yeah. Well, just to explain, the 10-year rate, the government rate does kind of dictate how fixed income move, and it went from 0.95 at the beginning of the year, or from November of last year, to 1.7 to March 30th, and from there came down all the way, and today is almost hit 122, 128. No, is surprising because many people were kind of expecting a higher interest rate, but interest rate move us oscillate a lot. So see what happened the second half.
That's right. That's right. It's always a fun quest to be on to understand the movement of certain indicators. Let's talk about inflation. I know that's definitely one of the biggest fears just out in the street, and also from an institutional basis of what that looks like. What impacts that can have, not just on the market, but the economy as a whole. So, Pablo, what can you tell us here in the graph here? I'll pull up to our viewers. What is causing inflation to start to pick up?
Yeah, well, inflation has been, everyone is talking about inflation, but basically I want to share with our listeners which is driving inflation, which are the items of the inflation, how the government calculates inflation, and which is driving this inflation. For instance, the inflation in this period that we analyze is the last from April 2021 to April 2020, kind of all the pandemic part. So the inflation, the annual increase was 2.8, no? But then which are the components? Like, for instance, energy, it has increased almost 25% in the US annually, no? Used car and trucks, and probably something our listeners, they were affected for that. They definitely every day when they go, they put gas in their car, or if they have an old car and they want to sell it, and suddenly now it's increasing price, which is very unusual in the US. Bacon, for instance, has increased 10% annually. Men pants and shorts, airline fares around 10%. And the other part that is affect our wealth, because this is important, housing prices. Housing prices last in the 10 metropolitan areas has increased around 10% and 12, 13%. You have this graph is the Standard & Poor's Schiller index, and also, for instance, I can experience my San Francisco life here now that I'm visiting the area. But basically, in the city, the price has been stale or declined a little bit, which is very unusual. But in the suburbs, it has exploded. So that's probably it's happening in every in the main 10 metropolitan areas in the US. And why is it important to our clients? Because if you want to buy a home, basically you have to increase your saving. You should have increased your saving 10 or 12%, because the price of the homes are going 10-12%. And if you want to keep out of the market, you have to increase your savings 10%. So this is important.
Yeah, yeah, I think that's an excellent point to understand. I know from clients we've heard somewhat consistently, should I buy a home? Should I buy a second home? Is it a good time? Should I wait? It's always a tough. I mean, obviously, individually, it's good to connect with your advisor, with myself, with whoever you work with here. If you're listening, you're not a client, feel free to reach out to us to make sure that you have a sit down conversation of what things pertain to you. The general information is there. I think I'd be really confident to say that there's a lot of great signs out there. And I think the question that you have to pose yourself when it comes to that is, interest rates are really low. That means to finance anything, specifically houses, it's fairly inexpensive and cheap, but home prices continue to go up, right? So if you wait, you may be caught in a situation where maybe home prices cool down, maybe they correct. There's probably not a lot of scenarios out there like that, in my opinion. But likely, though, interest rates will probably be higher here within the next 5 years. So you may end up in a situation where it's kind of a wash, right? Because you may be able to afford a home, but it's going to cost you more to finance it, and therefore you're going to be able to afford less of a home. We can sit down and kind of discuss your own specific situation to understand how that pertains, because there's so many moving factors in there.
Totally.
Pablo,
Yeah, and just very briefly, it's important also to put the money in a market, because again, market has been hedging this increased housing. So if you put it for 1 year, but definitely you should have always money in the market. For that reason, if the inflation of real estate is going 10-12%, unfortunately, the only way to hedge is through the equity market.
Yeah, and there's risk with everything, right?
Totally.
But think about what Pablo just said. If home prices are on fire, right? I think the median, as Pablo just showed, we'll reference the graph, is 12-13% here nationally in the top 20 metro areas. Stock market has performed 14% in 6 months. So it's definitely one of those things where you want to understand where to put in your respective wealth, what percentage. But let's do this. Let's shift gears here and give some expectations here as we enter the second half. I'll go back to what I mentioned regarding not seeing a correction. And a few months ago when we did our update, our guidance is still consistent with us expecting some type of pullback. I'm not stating anything new. And I think what we likely see sometime this year is probably some type of pullback, an actual correction of 10%, maybe more. July obviously has been volatile already, and we'll see if this is the month. I think if we're really putting our minds together collectively, Pablo, our investment committee, we maybe just don't see that happening just yet, maybe towards the fall. But the reality is that's why it's so important. And we discuss these numbers between equities and bonds/fixed income, why it's so important to be diversified, because at the end of the day, no one does have that crystal ball. And the only thing that we can control and mitigate is risk. And how we do that is by being diversified, being well allocated, understanding where we should maybe put a little bit more of a weighting, more monies in certain places, maybe like tech is looking pretty strong into the second half. But Pablo, any other last words here as we enter the second half of valuable things to both our clients and just investors that are listening in?
Yeah, well, basically, stay invested. It's very hard to time the market, and that's mostly for the people that they already have all their money in the equity market, either through retirement account or taxable account. But for those that they have new money, they sold a house. Again, any correction, any equity sell-off is a great time to enter into the market, because of course we're assuming that you have a time horizon of more than 12 months, not to try to do day trading, no. But if you have a time horizon of more than 12 months, definitely the market is the way to, is you have to take advantage of this discount, basically. Again, and this discount doesn't happen all the time. It's probably 4.5 months, maybe 9 months. So, but definitely you have to take this approach of taking advantage and not being, don't have fear. If market in the long term, it reward the people who stay invested.
Well said. Big picture too, where we're at, we just technically got done with the recession. The country's up and up. That there is a lot of positive signs that point to being a long-term investor and benefiting from that. And from a tactical standpoint, as Pablo pointed out, if you have cash to inject in these dips, I think that really long-term bodes really well for you in the next 5-10 years plus. Look, we really appreciate you guys tuning in. A special thanks for our clients for listening in. Hopefully this gives you an insight as to what took place, what to expect going forward. We'll see you guys again in August. For our viewers who are tuning in for the first time, thank you for tuning in. I hope you got a couple takeaways to implement with your own portfolios, your own investing. Feel free to leave us comments below. Subscribe to our channel if you haven't already. Pablo, thank you for joining us out in San Francisco.
You're
welcome.
welcome.
Look forward to catching up with you and everyone else next month.
Thank you.